In trading, we are often taught ways to catch trend reversals. No doubt, they are a part of trading, but the highest probability and safest trades are always found in trend continuation setups. That's why today, I'm bringing you 3 ultimate SMC trend continuation setups. These setups will help you take high-confidence entries within a running trend and keep you completely safe from fake retail traps. But before we move forward, remember the one universal golden rule for all 3 setups: no liquidity hunt, no entry. As long as the market doesn't hunt buyers' liquidity, the continuation remains weak. But once liquidity is swept, the continuation move becomes super fast and highly probable. For your absolute clarity, we will decode each setup using a structured 5-step framework, ensuring zero confusion and complete precision. Let's dive into our very first setup, called liquidity building before the zone. Let's assume a bullish trend. After a break of structure, the market can leave multiple demand zones, but the zone that has liquidity, like equal lows, building directly above it, carries the highest probability of continuing the trend. What are equal lows? Here's a quick explanation. Equal lows are formed when price touches a level multiple times, creating a visible support line. Retail traders see this support and enter buy positions, placing their stop losses right below it. This concentrated cluster of stop losses creates massive liquidity. What is liquidity? If you don't know what liquidity is, simply remember this. Liquidity exists wherever retail stop losses or pending orders are resting. Liquidity is the fuel for the market. When liquidity is hunted, price gains aggressive momentum. Keep this basic definition in mind. We will cover liquidity in deep detail in a separate video. So, when price sweeps these equal lows, it gives an early sign of a liquidity hunt. But remember, trading is a game of probabilities. The more confirmations you have, the safer your entry. Once price sweeps those lows and taps into our higher timeframe demand zone, switch to a lower timeframe. Watch for a clear market structure shift. Once you get that market structure shift, your setup is ready to execute. Place your buy order at the new lower timeframe demand zone, created by the market structure shift leg, and place your stop loss safely below the demand zone. For your take profit, target the nearest key lower timeframe resistance, or a major high on the higher timeframe. Now, let's look at a real chart example of this setup, so you can clearly see how it unfolds on actual candlesticks, rather than just line charts. Look here, after a break of structure. Notice how liquidity builds directly above this demand zone. Price then sweeps that liquidity and taps straight into our zone. Now, let's drop to the lower time frame to check for confirmation. As you can see, price forms a clear market structure shift, confirming that our setup is valid. Here is exactly how we execute the trade, placing our entry and adjusting our stop loss. And just look at the results. Now, let us move on to our second high-probability setup, the first pullback liquidity hunt. This setup is essentially a specialized variation of an inducement setup. I specifically included this setup in today's guide because of its extraordinary ability to capture true trend continuation moves. Now, inducement is a massive topic on its own, and I will be releasing a dedicated, deep dive video covering it in full detail soon. To master all these critical smart money concepts, make sure to subscribe to the channel and turn on the notification bell so you never miss an institutional breakdown. Now, this setup consists of 2 specific cases. Let us decode case number 1 first. Assume a clean bullish market structure. Right after a valid break of structure, price creates its very first pullback. Retail traders incorrectly assume that the demand zone formed on the first pullback leg is a valid entry point. Some traders immediately place pending buy orders at the edge of this demand zone, stacking their stop losses right below it. Others wait for price to touch the zone, and then enter, placing their stop losses in the exact same location. This concentrated clustering of stop losses creates massive institutional liquidity. And as I mentioned earlier, wherever stop losses are stacked, liquidity is born. Smart money algorithms drive price straight down to sweep this liquidity pool. But remember, To optimize our execution, we must switch to the lower time frame and wait for a clear market structure shift before taking any trade. Now, let us look at case number 2. After a break of structure, especially during high volatility market conditions, price might make a small pullback, push higher to break structure again, and repeat this process multiple times. In this scenario, we do not enter until the liquidity of the recently created first pullback is fully hunted. This is the core rule for case 2. Everything else, including our lower time frame confirmation, remains identical to what we previously discussed. The fundamental rule of this entire setup is simple. Only enter after the very first pullback liquidity gets swept, whether that sweep happens immediately after the break of structure or after a series of minor internal legs. Now, let us look at a real chart example. Notice how the market created this specific pullback before the break of structure. Price aggressively dives down to hunt the liquidity resting below this demand zone. Instead of blindly entering, we wait for our lower time frame market structure shift, confirm institutional alignment, and execute our buy order. And as you can see, the expansion that followed was absolutely flawless. Now, let's talk about our third setup: supply and demand within the liquidity hunting leg. In a bullish scenario, our entry is based on the demand zone of the very leg that hunted liquidity. Interestingly, this third setup is directly derived from our second setup. In fact, you can think of the second setup as the parent of this one. Let's quickly compare both side by side. The second setup forms when price sweeps the liquidity of an internal structure. The third setup, however, takes it a step further. It forms when price sweeps that internal liquidity and then aggressively breaks structure, taking out the major high created just before the retracement. The demand zone within this specific leg, the one that caused the break of structure, is highly probable. But why is it so high probability? It all comes down to liquidity. Market makers need massive liquidity to execute their institutional orders, and retail stop losses provide exactly that. When price sweeps internal liquidity and explodes with momentum to break a recent major high, it confirms one thing: institutional orders were placed here. Because these institutional orders are so massive, they cannot be filled all at once. Therefore, market makers drive price back down into the origin of that move to fill their remaining unexecuted orders. And that is precisely why entering from this zone carries such a high probability. Since this setup is already highly reliable on its own, lower timeframe confirmations are not strictly required. You can enter aggressively at the start of the demand zone, placing your stop loss just 1 to 2 pips below it. From there, trust the process. However, waiting for a lower timeframe confirmation, such as a market structure shift, will only boost the setup's overall reliability. And with that, our third setup is complete. That is all for today. If you found this video informative, please subscribe and hit the bell icon. If you want a deeper understanding of how the market truly works, stay connected with us.